Hello everyone, welcome to yet another all-time high day on January 10th, 2021. So we're going to run through today, check on chain, and just have a look at some of the various oscillators that we've got playing around. Obviously, we're well and truly in, I wouldn't even say bull market territory. We're in vertical and still sane territory. So there's no question that we've got an all-time high in the works for Ethereum. We've got many all-time highs long since gone and probably in the pipeline for BTC. So it overall, we're hitting greed metrics of 95% plus, and yet the market is remaining very, very stable up there, about 41,000. So, we are in a different paradigm to what we've all been used to. We've all been battle hardened through the bear market and going through the accumulation phase. And I think we're all thanking our lucky stars that we stuck around through all of that, and we weren't mad at the end of the day. So what we're going to look at today is each of the metrics, particularly around BTC. And what I would really like this to be is a bit of a demonstration on how we can use the probability histogram. So I see a few people pop up in the Discord chat just wondering what different Mayer multiple might mean and what a different Pure multiple may mean. So we might just run through Bitcoin specifically today and put a bit of emphasis on that probability histogram. I'm almost going to consider this as my equivalent probability cone to what Doc has for his trading videos. So it's more or less the same tool, but applied in an on-chain or a historical probability context specific to BTC, the asset. So let's start with let's keep it simple. Let's start with our Mayer multiple. Which I think I actually had one prepared earlier. No, this guy here. So for our Mayer multiple, let's just look initially at the fractal that we've got playing out. Through all of these cycles, we've noticed the Mayer multiple basically holds above, and we get tests of support in the early bull, and then away it goes. So we've kind of gone through our reaccumulation phase here, where we use the 200-day as support. We've gone through that phase here, albeit shorter and marked with this COVID dip. You can actually see here. It's quite interesting. This early bull market that we had back in 2016, it actually isn't too dissimilar to this if you were to ignore the COVID dip, right? So this is some macro event, but from that point on, we had a significant outflow of coins. So this really was a wake up call for the world, and we have a chart that I'll look at shortly that really actually demonstrates the amount of coins that have been pulled out of exchanges as a result of this, and has essentially continued to this day. So we will have a look at this after this metric, just to put that in a bit of context, because I think it is important to understand. And now we're most definitely in liftoff mode, and you can see that we've got this initial liftoff here where we came into the first resistance level that we've got here, which I believe is our caution level. So that's a 20% probability to keep going, 80% probability that it wants to go a bit lower than that. And you can see that that's where we started to get a little bit of chop. Now, what this looks like in the chart, so you can see that on the Mayer multiple, remember the Mayer multiple is the 200-day moving average. Even though price is actually heading higher, but we're getting equal highs through this zone here, what this is actually saying is that it's pulling back enough that the 200-day has time to catch up. So even though these peaks are necessarily higher, the reason that our Mayer multiple is flat is because at the same time, our 200-day moving average is catching up. So the distance between the peak and the moving average, the peak and the moving average, the peak and the moving average, is essentially remaining constant throughout each of these peaks until we finally get to this massive blow off up the top here. Our 2013 rally, we had more of a double rally, and Willy Woo was talking about this. And actually, just before we go to that exchange chart, we'll have a look at the cycle metrics chart, so we can actually see what Willy is talking about. It essentially went through this pump and then second pump. So we got two blow-off tops. Many analysts and various metrics always pick this up as a blow-off top. There was a recent metric that Philip Swift put together that I need to study a bit further that essentially identified this as a lower probability blow-off top. So that's something that I'll have in the pipeline. But essentially we had a double pump, right, which both of them blew into the the 95% get out now level. Whereas in the previous market, we essentially had nice pullbacks that allowed the 200-day to catch back up, and then we ran again. Pullback, 200-day, ran again. In this instance, we had our initial pump up to 14,000, where we got a very similar behavior to here. It was essentially the perfect Mayer multiple 2.4 rejection level. We've now essentially gone straight up into this second zone. So this is when we're up into the, this is in the sell zone. So this is our 10% probability of keep going. So technically this point here is 10%. So we're up higher than 10%. This would be our 5% level, a strong sell level. So we're starting to get into some territory where, you know, the probability based on the 200-day moving average, or the distance between it, is getting fairly significant. And just to really just, you know, paint this, I mean, you've all seen this chart or an equivalent on TradingView. I had to adjust my scale because I initially had this thing set for 30,000 because I thought, yeah, 30,000 would get me through to mid next year. Well, it didn't. I needed to go up to 50,000 now just to keep this thing in view. And you can see, I mean, our 200-day moving average is down here. So there's just a significant scale between where we are. It's going to take some time for us to catch up. And the question really remains, is it actually going to be BTC pulling back towards it at the same time? So that's my gut feel, is I think we have to be getting close. Sure, you know, we're kind of in that realm where a $10,000 move and then the blow off is well and truly possible. We're certainly going to get some volatility. And I guess the question is, do we have that level of buy support underneath? So we'll have a look at those the exchange flows shortly. But if we run back to our Mayer multiple, so just as a bit of an exercise to show you how you can apply these probability sets. So, you know, we have some arbitrary Mayer multiple. In this instance, let's look at this guy here. We're at 2.83. So we're, you know, 2.8 to 2.9 is kind of our range. If we take 2.8 as our value. In the Check on Chain website, we've got here under realized value, we've got our probability histograms. Now, this actually contains all of the metrics, the relevant metrics for Bitcoin. They're all in this one plot. So this is one I prepared earlier. So you can see here that we've got Mayer multiple, we've got MVRV, stock to flow, Puel, and difficulty. So all of these are in the same model. In this instance, each histogram, which is the bar charts and goes to the left-hand axis, is how many times an event has occurred. And the other line, the blue line in this instance, is mapping to the right-hand side, which is saying how much of Bitcoin's history is less than that value. So you can see that where the bulk of the bell curve is, we get the maximum increase. There's a lot more underneath these particular points. As we get into the long tail, we've already captured most of the points below it, so it's gradually drifting up from 95% to 100%. And if you're wondering how I get these lines here, which can be quite useful, not only because it points down and you can map particular values, but it also will point, so you can see that this one here on the CDF line is pointing to the right-hand axis. If we go to the bar chart, it will point to the left-hand axis. These are called spike lines, and you can see these up here in the very top of this corner. So if you pick this spike line level, if you turn it off, you just get your standard labels, and if you turn it on, you'll get individual labels, and you can also toggle on this one here. So you've got this is singular, or you can do compare data, and it will show you all levels, right? So you can see I've now got labels on all of the things I'm looking at. If I go to my Mayer multiple and I do spike lines, it's looking at individual metrics, right, and leveling up. Or I can go compare all of the data and it will show me all of these values. Yep. So if you want to do a comparison on what the actual price is across a bunch of things, you can essentially get a view on what they all look like. So that's just a useful tool. Let's return to where we are on a Mayer multiple of 2.8 at the current moment. So Mayer multiple of 2.8. If we map this guy here, so you can see this is down on the x-axis. We're looking at 2.8. So this is a Mayer multiple closing there. This is telling us that 94% of BTC trading history, 94% is below that particular level. So that means that there's only a 6% chance that price wants to keep running higher. Now that's still 6%, right? That's not zero, but it's telling us that we're getting into the realm where we should start thinking about, you know, whether you have hedging strategies, whether it's, you know, if you're a trader, you start thinking about upwards volatility, right? There's very possible that we could get a significant candle to the upside, which then gets faded, right? This is the kind of thing, it's not necessarily that we're guaranteed to pull back. It's that the probability is now increasing that we're going to get some kind of either consolidation as the 200-day moving average catches up. Normally a consolidation like that would be, you know, there'll be some kind of pullback. It could be a bear flag, it could be a bull flag, it could be any number of things. But essentially this is telling us that there is a 94% probability that the distance between the 200-day moving average and price wants to get smaller. That's essentially what this particular metric is telling us. It's saying that the 200-day either needs to catch up, price needs to pull back, or a combination of the two. So that's kind of giving us a bit of a realm and mapping onto each of these different functions. So just before we carry on, I just want to have a look at, there was a chart that David Puel put out the other day on Twitter, which was really, really useful. And he talks about the macro event that occurred following the actual COVID collapse. So let me just pull up the chart and we'll have a look and just understand a bit more about these exchange flows. So the first one that we'll look at is on Crypto Quant, which is this, it's kind of a similar system to Glassnode. And they've got the most recent data, or at least up to, so rather than Glassnode where they provide the, data up to, 3, 4, 5 months from where we currently are. I think Glassnode's even 12 months now. Crypto Quant shows the complete opposite. So they show where we're at right now. And importantly, if we're now looking at March, right? March 2020 is kind of the event that we care about. You'll have to take my word for it that pretty much everything was tracking up. So exchange reserves were tracking up all the way through to March 2020. And exchange reserves on aggregate, so we had 2.9 million, almost 3 million coins on exchange. And from that point, from that sell-off, there's been a very, very almost linear sell-off right the way through. Right, and we're now down here 2.35. So that's removing almost 20% of reserves on all exchanges, basically since that COVID sell-off, and it's a complete break to the trend. Right. So importantly, I'll look at David Puel. So he put out a tweet the other day. I think this is honestly one of the most bullish charts I've seen for Bitcoin in a very, very long time. And what this is essentially showing is we can measure coins based on their liquidity, right? So if you've got coins that moved in the last year, they're probably relatively liquid. The more they've moved in the last year, the more likely they are to move again. Satoshi's coins, pretty unlikely to move. Old miners from back in 2010, 2011, probably unlikely to move. A lot of those coins that are kind of either lost or held, in cold storage, they're not going anywhere anytime soon. What this is showing us is essentially the coins. This is what we're calling the highly liquid supply. So these would be coins that moved, maybe within the last 6 months. I'm not actually sure what the exact metrics are in terms of the cutoff dates, but for illustration purposes, something under a year. So we're talking about coins that move within the last year to coins that have not moved in a very, very long time. And this would also account for exchange balances and things. So he says here, I think he says in this one or in the tweet before, they look at essentially entity adjusted, which is saying, some coins we know are held by exchanges because we know what those balances are. Some coins we know are held by certain people. So they basically map some of these volumes and say, well, they actually are an exchange and inflows, outflows, and so on and so forth. Anyway, the short of this story is saying that we've essentially had increasing, right, the ratio of highly liquid coins that are moving around the system on a regular basis, versus the coins that are essentially in illiquid supply. And this makes sense because we've got a near linear output from miners. So those miners are bringing coins onto the market. Most of them are being sold and moved into circulation, and they're being traded around, and prices going up, and people are selling, and so on and so forth. But then what we have is the March sell-off, right? The COVID sell-off. And this is essentially when Bitcoin stepped onto the global macro stage. This is where people started paying attention to it as a genuine solution to the problems that we were facing. It's a solution to many of the trust issues that we have. It's a solution to the monetary side of things. It's essentially, this is where people started taking it seriously. And now, so when you have lots of coins moving around, highly liquid supply, and not many cold storage, you essentially have an uptrend, right? An increasing ratio. That inflection point completely broke the trend and has continued ever since. This is essentially saying that more and more coins are being pulled off exchange, put into deep cold storage. Coins are not coming back into circulation. So that's essentially what is going on here. And it's also important to note that roughly March 20th, that's roughly where we had this breakout for the 14K back in 2019. So this particular metric itself will be taking into account two things. We'll be taking into account coins that have clearly been moving in the last, short span of time, and when they're coming off exchange. So that pulling off exchange is similar to what we saw in that previous crypto quant chart. That's telling us that coins are coming out of exchange bases. And simultaneously, what we're also seeing is coins that were purchased back in this rally, right, that are hitting that 12-month period. So people initially were buying back here in the dip, right, down here at $3,000, $4,000, and then accumulated through this rally. All of those coins are now being classified from the younger than 12 months to older than 12 months. So that's essentially saying that those coins are not moving either. So it's actually a double whammy as to why we're getting coins not being in circulation. So again, this is a pretty macro long-term bullish chart. I think it's one of the most bullish charts I've seen in a very, very long time. So on the bull case of this whole thing, this rally is 100% organic and it is spot driven. This is not a short squeeze. Back in 2019, that was definitely a short squeeze. That was leverage and derivatives. This is spot. This is genuine lack of supply coupled with more money coming in. So I think that is why we've seen such a, it's been a parabola, but it's been a fairly tightly controlled parabola. We haven't had any pullbacks really. So I think there is a logic to why this is. And I think this chart and the supply dynamics is really telling us that story. However, with that in mind, right, we are still, so this is kind of the picture I'm trying to paint for you all. We have a very, very bullish macro backdrop, but nothing goes vertical forever. So this is kind of the realm where I think we're sitting in, is that we know that long term there is most definitely a bullish fundamental side to this. But we have had a very stellar price rise. We do know from markets in general that eventually we're going to move into a parabolic phase, which I think we're currently at or certainly approaching the top of. And it's now getting to the point where if you're a large institution and yes, your mandate is to go and buy some BTC, you've got approval and all the rest of it, and you walk into the market and what you see is a giant parabola standing in front of you, most institutions know what happens after a parabola occurs, and they're probably not going to be stepping in and buying a $41,000 coin. At the same time, we're getting lots of anecdotal, altcoins are starting to move. Anecdotes are saying that, people are calling them up and saying, hey, you're the Bitcoin guy. How do I get on this train? I think the market's starting to transition to perhaps what could be classified as a more retail-driven blow-off top rather than Michael Saylor stepping in and buying $40,000 coins. Michael Saylor and his, kindred spirits, they know how to play markets. They know how to play markets far better than retail, and they want retail's coins, right? They know that they need to generate supply. If we also look at the miner position index, so this is another one of these crypto quant systems. So this is essentially showing, for want of a better term, the ratio of BTC leaving miner wallets, so these are essentially freshly mined minted coins, relative to its 1 year moving average. This is not too dissimilar to like a Pure ratio, which is looking at miner income versus the 1 year moving average. This is essentially looking at, are they spending more coins than their 1 year moving average? Now, values less than 1 is essentially saying, right, if you have values less than 1, or in this case, I think they've normalized it to 0 actually. A value of 0 basically means that it's essentially equal to their 1 year moving average. Once we get up to 1, it means that they're selling about 100% or double what they were a year ago or over that period of time. 2 is then they're selling 2 times more, 3 is 3 times more. And you can see actually that through this whole rally, essentially price and miner index have been following each other. So this is actually saying that miners are now starting to liquidate some of their treasuries, not necessarily treasuries, but their mine supply. So, they are starting to take advantage of these high prices. Now, of course, we know that miners are becoming an increasingly small sell side pressure, but we have to look at the psychology of what's going on here. So we know that coins are coming off exchanges. We know that we're in a parabola from a technical analysis perspective. First metric, and we'll look at some more of these. Let's get rid of this guy. Mayer multiple. First metric, we're up into the 90. We said 94% is less than this. That means we're in the 6% range. So just based on the 200-day moving average, we're starting to get into the hot zone. We've got miners who have clearly recognized this and are starting to sell into that trend, into that strength, which is, to be honest, makes reasonable sense. Let's get rid of our exchange reserves. Let's have a look at just a couple more metrics just to kind of balance out. We'll look at MVRV ratio, unrealized profit and loss we can quickly touch on. So MVRV ratio, oh no, hang on, sorry, I've broken this. Give me 2 seconds. Sorry, just to update my code, I've been in the process of getting some settings so we can turn off these lines for the public version and for the RSC version as we evolve that over time. Anyway, carrying on. So the MVRV ratio, this is realized price, I don't realize cap. So in a very, very similar manner, we're up here into the strong sell 5% range under the MVRV ratio, or very close to. So that's at 46,000. So actually, let's just zoom in. You can see that we've essentially broken through our 10% level. We're somewhere up here between, this is roughly 6% if we just eyeball something like that. 45,000 will be our 5% level. Back here at 32.8 is our previous level. We've got our realized price, which is an uptrend. This is positive. This is telling us that we're probably into the second phase of this bull. In fact, it confirms that we're in the second phase of this bull. And if we do a very similar exercise, so our MVRV ratio is currently 3.78 or 3.8 if we want to just round up. We had a similar pattern back here in 2017 for our MVRV as we did for our Mayer multiple. So it allowed that pullback and the realized price to catch up a little bit. You can see that we basically just dipped a toe into this these peak zones before we got the pullback, and we're getting close. So we are into this zone where we got significant pullbacks in pretty much every single previous cycle. And it would make sense that we're starting to get into that realm. If we jump back to our probability function and we now look at our MVRV, let's turn this guy on. We said 3.8, didn't we? 3.8. So 3.8 is now mapping to this point here, 94%. So exactly the same as the Mayer multiple. This is saying that there's a 6% chance that we keep going higher, and there's a 94% chance that it wants to spring back lower. So this is giving you a bit of a probability framework that we can use moving forward on that. And if we look at our unrealized profit and loss, so this is essentially taking the difference between the current spot price and the realized price. So think about your realized price as the market's aggregate cost basis. And then the spot price is obviously what it's currently trading at. If you were to work out the market's current P&L, right, what did you buy it for, and what's it currently worth? You can see Euphoria Greed is this red color. You can see that we've just tagged up into Euphoria and Greed. So this is trying to tell us that right now in the market there's about 73.6%. The entire market on aggregate is at a profit of 73.6%. That's non-trivial. Right, we've only really been in this Euphoria Greed zone for a very, very small portion of time. Normally that signals that we're at some kind of significant topping level. So again, this is another metric that there is a lot of profit in the system. There's a lot of profit from people who have a lot of value, a lot of money in the Bitcoin system. Miners are starting to liquidate their treasuries. We're in overblown territory for a number of these metrics. And the smart money, who generally coincide with the people with lots of money, they know that when a parabola occurs, they can probably blow the thing off and buy it again cheaper. So my best guess as to what we may see in the near term is essentially we'll get our blow off top at some point. And I think that there is going to be motivation for price to go lower and for weak hands to essentially sell out, right? There's enough new retail hands coming in that some of that money needs to flow back into the pockets of the people who really spin the story. And ultimately, I think that's probably the most likely scenario at this point in time. So, my general gist is that we have to be getting close to some kind of corrective level. I'm not exactly excited if we just keep going, because ultimately I think it's building up a system where you need to go down to go up. And I do fear that if we keep going up in this vertical fashion, it's going to end up in a much, much larger and angrier hangover, which I don't think anyone really wants to deal with. If you look at our 14-day gradient oscillator, so this is looking at momentum, and the height of remember the height of these peaks is essentially the rate of change. So the higher the peak, the more vertical the system is going. And you can see here that we're at a level that really hasn't been matched. It was matched twice, right? One in 2017 and one at the blow off top. Both of these blow off tops. And you could, the blow off top, but some of this early stuff is fairly young, so you can probably ignore that. But you can see that normally we were getting some kind of oscillation, right? You get updrafts as well as downdrafts. You get up, you're down to go up, down to go up, down to go up. In this instance, we've basically gone up and up and up to go up. We haven't had enough downwards energy to kind of correct that whole system and bring it back into equilibrium. So, that's starting to point to it. Our 142, 140 day, we normally do get a fairly strong rally. So once it gets above zero and we move into a positive trend, it essentially holds that for the entire distance. You can see the same type of pattern showing up as the Mayer multiple and the MVRV ratio, with these even equal highs and then a final blow off top. Here we've essentially been in this uptrend, so you could almost equate it to this zone here. Our peak right now, let's bring up our spike lines. Our peak is roughly equivalent. I mean, it's almost getting into blow off top territory, right? So it is starting to look a lot like the 2017 top, and really the parabola is not too dissimilar. So there's more similarities with the blow off top than there is with the previous corrective action. So that gives you a bit of a sign of just what type of market we're currently in, and the probabilities that may be looking at us from down the line. We mentioned let's look at our mining systems and just see what's going on with the miners. And then let's also look at MVT, RVT. And this is the last metric we'll look at, which I find pretty exciting. So the difficulty multiple, remember that this is taking like a stock to flow regression model of difficulty. This gives us an R2 value of 95% and higher. So it's actually far higher conviction than the stock to flow model. If you can believe that. So this is trying to give us the aggregate essential cost basis for all the hashes on the network. What does the difficulty tell us right now about the value of BTC? Now, one thing that we do have to take into account here, you can see that difficulty has essentially traded sideways. And this is very, very interesting. I believe this is actually because there is a shortage of ASICs available for purchase. So due to the COVID shutdown of many supply chains and things going on around the world of that nature, my understanding is that there's actually a shortage of machines right now, of ASIC chips. So people actually can't get ASICs to expand their system. So that's something to probably be aware of, why the difficulty is not necessarily picking up and screaming north. But it's also a case that you just need a hell of a lot more hash power to move difficulty these days, because there's so many machines currently working on it. But if you use difficulty and do a regression, that's telling us the price should be back down at 10,000, which clearly we're well beyond that. But in terms of distance, and you can see actually that during blow-off tops and bull markets, it actually strays quite a distance away from the difficulty price. So this is not abnormal. You can see that it really trends through the very, very slow, casual, almost the long-term mean. So it does make sense. But to give you some perspective, we are up here again, we're approaching the strong sell level, which is up at 52,000. And we've passed through our 90% level, which is 34,000 or thereabouts. So our current difficulty multiple is 3.93. If we jump back to our, where is it? Here it is, probability. Let's look at our difficulty histogram. What did we say? We said 3.8. If we look at 3.8, 97. So 97% of all trading history is less than this particular value. Oh, sorry, that's pure. Sorry, forgive me, difficulty. I'm all over the place today, I apologize. So this is telling us that we're 86%, so 15% chance that it wants to keep going higher. And that would be, what is that, 14% chance, sorry, 14% chance it wants to go higher, 86% chance it wants to go lower. So, not necessarily as overblown as our previous metrics, but certainly still telling us that there is more heat in the market than not. And next we'll look at the Pure multiple. So the Pure multiple, this is the 1 year moving average of miner income. So this is basically how much USD they've got coming in the door on a 1 year average basis. And then this is the actual miner income. These zones are red because during, as we've seen in that miner crypto quant chart, when we've got price that's above their 1 year average, they're incentivized to sell and actually take profits more or less because they're buying coins with power. and they're essentially selling for their stakeholder value, more or less. And you can see now we're quite some distance above the pure multiple. We're actually up into the minor profit zone. So again, we're in that 10% zone. Current pure multiple of 3.1. You can see that, again, same pattern that we've seen across all of these things. Bitcoin is a cyclical creature, and we're seeing it across many of these metrics. So at a pure multiple of 3.1, pure multiple 3.1, 3.2. So 3 is 93%, 7% chance we keep going, and 94. So almost identical. So we now have the MV/RV ratio, or the realized price, the Mayer multiple, and the pure multiple all telling us the exact same story. And that is that right now BTC is currently there's a 6% probability that it wants to keep going higher. So that's giving us a bit of a view. We've got miners that are selling. We've definitely got coins coming out of exchanges. So long-term macro bullish, starting to look like we deserve a correction right now. So again, this is not necessarily saying that things are going to fall over and and break down, but it's telling us that the probability is starting to get there to start being a little bit cautious about things. If we look at our NVT price, so this is Willy Woo's newest metric. Sorry, let me bring that back. So we've got a few different metrics here, the 28-day NVT price and the 90-day. So what this is essentially doing is it's looking at how much value is flowing through the chain. So how much is being settled on chain, and then it's trying to say, okay, based on previous NVT ratios, what kind of valuation does that map to? And what this is currently telling us is the NVT price is at $35,000 on the 28-day basis. 90 days obviously a bit slower. That's back down here at 20,000. So that's starting to break previous all-time highs. Our RVT is now down into the green zone, so this is positive. This is telling us that we've got a fairly substantial amount of chain activity relative to the value stored in the network, the realized price. We're maintaining this horizontal behavior in the NVT. So this is not necessarily saying it's bearish, even though it's up in this red zone. The horizontal trend is saying that basically transaction flows are matching price rise. However, we're starting to get more breaks to the upside. So higher values means there's not enough volume on chain to support that kind of price. Lower values are saying that there is a substantial amount of volume on chain, and that justifies the price. So low values is justified transactions, high values is not, and the trend is equally as important as the level. So for the NVT, this is saying that through most of this, as an oscillator, yes, we've been able to maintain. So through this price rise, and you can see this with the purple line, through this particular market phase, the transaction volume is essentially growing with the price. We're now starting to move a little bit higher. If this becomes a trend and we get the MVT breaking higher, that's another justification that it's probably starting to cool off, right? This rally could be starting to cool off. And just one very, very final thing that we'll close on. Let me grab this guy here. This is a really interesting metric. So just to kind of summarize before we close out, what it is telling me is that we are in probably the back end of a parabolic move. It is likely that this bull market will continue, but it is also 6% probability that it keeps going right now. So I think some kind of corrective move is probably more likely. The volatility is probably going to be pretty fun to trade, and what actually happens to altcoins is probably something to keep an eye on. So obviously ETH is getting ready to break all-time high, and I'm not going to lie, a significant pain scenario right now is everyone is believing that ETH is going to break through all-time high and bring alts with it, just the same way that BTC did. What would happen if we got a huge pullback right now? And it affected altcoins as well, right? When I think about how many people have now transitioned and moved their value from BTC, right? They're starting to rotate profits. What would happen if much of that value got evaporated? To me, that feels like a pretty painful scenario. Again, it could be we'll have to wait and see what actually plays out. But that to me feels like a max pain scenario right now, and miners are clearly selling into it. I think that the Michael Saylors of the world believe they can probably get a cheaper price, and they can get a cheaper price with high volume, and they have the money to actually do this, right? There's a lot of traders in this market and whales who kind of move price around in this regard, so particularly in altcoins. And another thing that kind of tricked me today or triggered me was The real bottom of the barrel shitcoins pumped today. Dash, BSV, Bcash, what else? Stellar Lumen, some real garbage that's up there in the top 20, top 30. Some real garbage pumped today, and in general, they are pretty easy to move, right? They're fairly illiquid markets. It's fairly easy for people to actually move those coins. It's bizarre that they all moved in unison. And to me, that's a large player or a number of large players saying, look at me, you can buy absolutely anything and you can't lose right now, right? This market's stupid. Let's come play ball. That's something to just be aware of, is that there is a level to that in this market. Obviously it'll deteriorate with time, but particularly in the altcoin space, most definitely those big whale plays are absolutely part of the system. So it's anecdotal. It's kind of my gut feel, but it's just an observation that's kind of what that real garbage rally tells me, and we have seen that play out in the past. So just to close out, this is a really cool and very interesting fundamental metric that Parabolic Nino came up with. So we all know that the blockchain has a data size, right? So if you look at how many gigabytes Bitcoin currently is, I think it's about 300 and something gigabytes. And we divide the market cap by the bytes, right? So what is the chain worth per byte that's currently on the chain, right? So the blockchain is always growing, market price is fluctuating. That's what this black line is showing us, right? It's telling us value per byte. So this is saying, let's say at this peak here, that right now, at this point here, 35 cents per byte, right? Was currently there. The network was valued at 35 cents per byte. If you do the same for the realized price, this now tells you that 6 cents were saved or stored value. How much value was stored in the chain as the cost basis versus the byte. So, 6 cents per byte. Like here is 35 cents. And you can see that so this is the first cycle. We came up and we tested 80 cents, right? This is the $1 mark. So this is saying that $1 per byte is valued in the chain. And this orange line is based on total cumulative settled value. How much value has Bitcoin transacted? So value stored per byte in blue, network value or market cap per byte in black, and cumulative value settled by the chain in orange per byte. And interestingly, this has acted as both almost like a Bollinger Band system, right, over the macro course, which is quite interesting. Less so in this point here, but you can see that the $1 mark has essentially been like a massive ascending triangle, right? Bitcoin's been building up to this $1 per byte. It broke through it in the 2017 high and then crashed below it, came up, and is now re-breaking it. It's up at $2.36 per $2.36 per byte. And if you think about this as the amount of value that the network is storing per, what is the data density or the value density of the chain? This massive ascending triangle has been building up to $1 per byte for a very, very long time. During this whole process, I mean, back here, Bitcoin was a medium of exchange, right? It's going to be it could be money, or it could be a way to, buy stuff on Silk Road, or it could be all these different narratives are bouncing around what Bitcoin was. It's a payment system. It's a store of value. No, it's a monetary network. It was all these different things. As time has gone on, right, we've had the Bitcoin Cash fork, so the payment system people have essentially forked off. Over time, we've developed this store of value narrative as the dominant system, and we saw that during the March sell-off, we moved into this new macro environment where more people are taking it seriously as a store your wealth, protect yourself from inflation asset. So I find it really fascinating that we've been building this technical analysis, right? Ascending triangle, building up to this $1 per stored per byte. And then at the exact time that we break our third all-time high, and we have institutions who are looking to store huge sums of money. Michael Saylor needs to store $1 billion, right, to protect from inflation. So the amount of value that's actually literally being stored in BTC per byte is naturally going to increase in a very, very significant way. And we know that ascending triangles, if you look at your probability of breaking upwards, is pretty high. I just find this a really fascinating organic pattern that just happens to have shown up. And at the exact time that people are stepping into this market looking to save a huge amount of value per byte, we actually get this break above this ascending triangle, and more than likely it's trying to get up here to this $10 per byte type level, right? Acts as this Bollinger Band type system. So it's more of an organic, the organic nature of Bitcoin, a bit of a funky insight. If you don't fully understand what I went on about, sorry, I'm a bit tired today, so I've kind of bounced around a little bit, but hopefully the ideas are there. Just be careful. Just understand if you've got leverage plays on, just be aware of it all. And there was actually one thing that I just wanted to bring over to everyone's attention. As we move into this next phase of the bull market, it is highly probable that Ethereum prices are probably going to break all-time high. And it is highly likely that on-chain transaction fees could get quite expensive. So I today attempted, I'm still in the process of trying to do it, to close down some of my DeFi positions, not the tokens, like actual smart contracts that I have coins locked in. A very simple withdrawal from Compound today at 50 Gwei was the equivalent of $35, I think. So just be careful if you have any DeFi positions open. Be prepared for this market and the gas price to get a little bit stupid, right? Really high and just expensive, because we're about to have retail FOMO at some point in time. There's going to be a whole lot of on-chain activity. There's going to be a whole lot of people. We could get DeFi Summer 2. There could be all of these things that actually lock you into a position that you can't close down without having a significant amount of ETH on the line. So it's just more of a PSA to just be aware if you have any DeFi positions, just start thinking about how and when you're going to exit it. In general, weekends are softer on gas, so normally wait for the weekend on a Sunday to try and close down some of these positions. You'll try and get a cheaper gas price. Maybe drop something in the mempool and just see if it can clear over the week or something like that. Being aware that if you put something in the mempool, you may not be able to send another in fact, you won't be able to send another transaction till it confirms. Just a bit of a note to just be aware of that, because we could get some pretty crazy gas prices, and just be conscious of that. I don't have a slide for this week's podcast recommendation, but I highly recommend. There's 2 pods, both with Jack Mallers. One was on What Bitcoin Did. The other one was on Investors Podcast with Preston Pish. I highly recommend you listen to both of those, because it gives you an insight into the Lightning Network and what Jack has just announced with Lightning Strike. It truly is a game-changing system. It's taking advantage of Bitcoin's liquidity. It's creating international payment rails in 200 and something plus countries that's allowing people to access. I can send Australian dollars and you can receive US dollars. And it utilizes Bitcoin on the back end. It's got nothing to do with Bitcoin, the coin. All it's doing is essentially using it for its liquidity. So this is a true example of using the Lightning Network and the Bitcoin network, irrespective of BTC, the asset. So it is that distinction between using a monetary network, which is the transaction capabilities of it, or the payment system that, people split off from in 2017, the payment system network versus the asset. It's a really, really nice split between the two. I think it's a really game-changing product. I'm really, really excited for it, actually. I think it is truly a killer app, and Jack has been absolutely killing it of late. So it's worth checking out, and otherwise, other than that, I'll catch you in the chat rooms. Cheers.